operating income, and most people tend to call it effective gross income. Same thing, but just different nomenclature. All right. So 180,000 minus the 9,000 plus 10,000 gives us 181,000 as our effective gross income. Okay? Everybody cool with that? Yes or no? Now, the way that I tend to think of effective gross income is that's the real hard currency that basically gets deposited into your bank accounts over the course of the year. Okay? That's real money. All right? Now, the next line item, total operating expenses. Okay? Now here we can have some differences occur depending on the kind of leases that we have in the property. All right? You know the difference, or maybe you've heard the difference between gross leases and net leases. Okay? A gross lease is where the property owner pays all of the operating expenses associated with the property. Think of it as an all bills paid kind of situation. Kind of like dorms, okay? If you move into a dorm, you're basically getting a gross lease in the sense you pay one big lump sum amount. They take care of virtually all of your electricity, all of your water, all of that sort of stuff. It's just one big gross lease. Does that make sense? On the other end of the extreme is what would be a net lease or an absolute net lease, where the landlord takes care of no expenses. The property tenant takes care of everything, okay? Those are kind of the two polar opposites. Now, most leases tend to fall somewhere in between those two, but on the extremes are the absolute net lease and the absolute gross lease. And so, like an example of an absolute net lease, like a lot of the big box tenants and the ones that are in those out parcels, in many cases, they're leasing those on 20, 25, 30-year leases where they, as the tenant, take care of every conceivable expense associated with the property. They take care of the property taxes as the tenant, they take care of all maintenance, they take care of all improvements, changes, modifications pretty much to the property, okay? At an extreme, all right? Is everybody clear with that, yes or no? Okay, because that can make a huge difference from your perspective as the owner or investor in the property as to who is covering those operating expenses. So in an absolute triple net property, you basically would have no operating expenses to speak of. Does that make sense? Whereas with a gross lease property, as the owner of the property, you're going to have a lot of operating expenses. So let's just assume it's somewhere maybe in the middle, and we've got operating expenses of, I don't know, I'm just going to throw out a number, $30,000, okay? So in this case, that's going to leave us with what? 151,000 as our net operating income. Is everybody cool with that? Yes, no, possibly could be. All right, so now, that 151,000, if we had paid cash for the property, we had borrowed no money from a lender or from anyone else, and we could just simply plop down the purchase price on the property, that number would be the number that we would walk away with on a before tax basis and be able to use in any way we sort of wanted to, okay? Now, the likelihood of us paying cash for the property is really low, but it happens. So part of what we're going to be dealing with, especially in this course, is going much further beyond just the net operating income and going into before tax cash flow and then ultimately after tax cash flow. But for right now, we're just going to sit here with our net operating income and we're going to do a couple of things with this. One of the things that you may or may not have heard of is a cap rate. All right, so let's kind of explain this concept of a cap rate. A cap rate, simply defined, is what is the rate of return that you need to offer on a real estate investment in order to attract capital to the property, okay, or to that investment. Cap rate is short for capitalization rate, Okay, so the idea is, how do you get your property funded? You've got to offer a certain rate of return in order to get investors interested in it to be able to capitalize the project. Okay, that's where that comes from. So in this particular instance, what we use to calculate that cap rate is we use our annual net operating income on the property, in this case $151,000 for this particular property, and we figure out, well, what is the required rate of return that our investors demand in order to invest in this kind of property. And that cap rate is going to vary by property type. It's going to vary by the market in terms of, are we looking at Miami? Are we looking at, downtown Fort Lauderdale? Are we looking at Weston? Are we looking at, some, other location outside of Florida? Are we looking at a tertiary market, or meaning more like a outside of suburbia? Are we looking at a downtown area? There's a lot of different. There's almost an infinite number of markets that you can begin to parse this down into as to where that cap rate's going to sort of come from. But it's all determined by the participants within that particular market and their perception of risk and return. Okay, that in most instances there tends to be kind of a coalescence around what that number is going to be for any given market. And what we are currently sort of seeing, and have been for several years, is that there are certain property types that tend to be viewed as being less risky than other property types. Okay? Traditionally, multifamily residential has been viewed as one of the least risky property types, whereas retail, for the most part, especially now, is viewed as being one of the most risky. And one of the reasons, obviously, we can get into all that whole discussion of how online retailers are killing the traditional bricks and sticks retailer. Well, that makes it obviously more risky for people who are willing to invest in those properties, and it's going to take a while for that to kind of flush through the system. And then everything else is kind of in between, okay? But that means that rate of return that we have to offer for a single family or a multifamily residential property might be 3 or 4 or 5%, whereas for retail it could be 10, 12, 13, 14, 15%, okay? So let's just say, in this case, we're dealing with multifamily residential, so we're going to make that cap rate 5%, all right? So now what we do is we use our friendly little formula that we call REE, okay? Which is income divided by rate, which gives us value, okay? And so anytime that we're solving, we're just simply covering up the piece that we're solving for. So in the case of trying to establish what the value is for this property, we basically are covering up the value, taking the income, divided by the cap rate, that's going to give us value, all right? So 151,000 divided by 5% would mean this property, to attract investors, could be priced at around $3,020,000, okay? Does that make sense? Now, if investors within this market view this as maybe being more risky than that 5% yield or 5% cap rate, that value number is going to go down. So, for example, if we were to require a 10% cap rate to attract capital to this property, what you're going to see is that that value drop pretty much half to $1,510,000 just because of the perception of risk associated with that particular property type. Does that make sense? So a good portion of that cap rate is determined by what are prevailing interest rates within a market, but also tangentially with that are the perceptions of that market and of that property type. And when I mean perceptions, I mean what people think, okay? And it's not a firm number that sometimes you can really absolutely nail to the wall. It can change from one news cycle to the next, okay? but all of a sudden you've got some really negative local or national or regional news that can have an influence on cap rates, okay? Does that make sense, everybody? Yes or no? But also, in that perception, kind of bound up in there, is, let's say that you're intimately familiar with a particular market, all right? That you know every single player, you know every single transaction, you know every price point, every lease rate, every lease expiration, you know everything about that market. My expectation would be then you would have a lower, potentially, a lower perception of risk about that market, that, you know, assuming that the market fundamentals are good, than maybe an outsider would, okay? Because they wouldn't have that same exact market knowledge, that depth of market knowledge that you might have, so they're going to have a higher perception of risk, therefore demand a higher cap rate. Does that make sense? Okay? Okay, moving forward. All right, so any questions up to this point?
So the cap rate is that R, or is the cap rate like the D?
Now the cap rate, yes, this is the cap rate. And this is the value.
And so the actual rate of return could be different than the cap rate?
Yes, because the rate of return will also, in many cases, take into account the use of debt. And so you're going to have a leverage effect that is potentially going to occur with the use of debt that can influence basically the overall rate of return.
Gotcha.
Okay, which we're going to get into a little bit later. Okay? All right, everybody good at this point? Yep. Okay. All right, so let's just take a look. Got you through a couple of the little fundamentals there. Okay, a couple of other little things that they throw in here. Gross rent multipliers. Okay. One of the things that you do whenever you're trying to evaluate a property is you're looking at all different types of metrics, okay? You try to understand what is the performance of this property. And in many cases, what you're trying to understand is the relative performance of one property to other similar properties within a market, okay? You know, it's the same sort of thing if you really, you know, think about it in residential terms. You know, if you're looking at, you know, you see a house that's sold in this neighborhood, all right, you would expect that a similar house in that same neighborhood with similar features would sell for virtually the same price as the other one, yes? Okay, so the same sort of thing applies to commercial investment property, but it's usually dictated more by income numbers. Okay, and what the income potential is of one property relative to another. But having just said that, obviously, you know, if you look at one, let's say, apartment community versus another apartment community, there are always going to be differences. You know, whether it's a locational difference, whether it's a quality difference of the quality of the neighborhood, quality of the units, size of the units, you know, all of those sorts of things are potentially going to be different. But we still want to have some broad metrics that we can kind of begin to use to sort of look at what may be happening in the marketplace. Well, that's where the gross rent multiplier sort of comes into effect. Is what you're doing is you're looking at the maximum, that number one top line, this number here, okay, and you're saying, how does that number relate to what that property sold for, okay, or its value within the market. All right, well, in our case, we've already kind of backed into it, and we said, okay, if we went with our original set of assumptions, the original value was $3,020,000, yes? So to calculate the gross rent multiplier, what we're going to do is basically take that 3020 and divide it by the 181,000, and that's going to give us,
So it's the EGI, not the PGI?
in this case, it's a gross rent multiplier, so it's actually, I'm sorry, it is 180,000, my bad. Things all right here. Yeah, 180,000. All right, divided by, and so we get a gross rent multiplier of 16.77 out there. Okay, so what we're saying with that, very simply, okay, it's a very rough measure, but it's saying that this property is trading at or selling at a 16 multiple, okay? Those of you that are finance majors or have had finance backgrounds, you talk about multiples in terms of, what is, like, earnings per share, and you start talking about, all sorts of other sort of metrics that look at basically what is the relative value to the overall income that the property is or the company is generating. You're doing the same thing here. You're simply saying this property is generating 16 times its earnings, okay,
Right,
or 16 times its potential earnings or revenue. Does that make sense?
Relative to its purchase price.
Relative to the value or purchase price, okay? Now, what you would do is you would look out in the market and you would see, okay, do I have other properties and what is their gross rent multiplier? And so, for example, let's just say that I found a variety of other properties and one of them is at a 15, one is at 12, one is at 8, and one is at 18. Okay, so what would these multiples tell us about those properties relative to this one? In other words, which one is better, which one is worse, which, think about it.
Everything else equal, the one with the highest GRM would have the highest risk.
8 would be better because it's cheaper.
Okay, so if this one sold at 8, that means that it sold for a lower multiple of potential earnings, okay, which could imply, just really roughly, that this one is undervalued.
Yeah.
Okay, this one might be one we want to take a serious look at because it could be one that could be scooped up for a bargain basement price relative to what we have with this particular property. Does that make sense? Whereas this one, at the high end, we could say, wow, there must be something special, theoretically, about that one relative to our property that people are willing to pay that much more times the earnings, that maybe it's a brand new property.
Yeah.
Maybe, the source of income is more solid. Maybe it's in a better neighborhood. But this is, once again, I'm not avoiding you, but I want to make my final point about this. This is an extremely rough measure. This does not take into account really what your occupancy rates are. This does not take into account your expenses. This is simply a very top-level number that, quite frankly, could be manipulated, especially if you're overly optimistic as to what the rents are for that particular property. Okay, comment?
That could just be a timeline too.
Sure. It also could be that over time, the market has changed, in terms of the relative sort of perception of risk and ultimately what people are willing to pay that many times over their earnings, okay? Because this is the same sort of thing that can also occur in the stock market. I mean, one of the a broad category of companies that trade at many times over their earnings are typically what? High-tech companies. Because everyone is banking on the expectation that something big and something magical is going to happen from those high-tech companies that everyone wants to believe in. Whether or not it's realistic or not, that's a whole other sort of viewpoint. Yep.
But a lot of, just like on the stock market, a lot of the variables that go into that can be manipulated.
Yes.
Just like, I mean, it's manipulative. It's not something that you should definitely purchase the property because you got a gross rent multiplier of blank.
As I said, it's merely one of several different metrics that you can use.
Okay.
That's the best way to sort of say, okay, yes, sir.
So what if you were to do it based on the net operating income?
Then you would have net income multiplier, okay?
That's more
Yeah, no, and look,
easier and better to achieve.
no, I mean, actually, that's exactly what you could do. You basically could have the net income multiplier, which is pretty much the same thing. You would simply take the same purchase price, but then you're gonna take then the net operating income, which is 151,000.
But then you could compare that to the other ones.
Correct. And so there, it would be a 20. Okay, but it's 20 times your net operating income. And so once again, you're looking at a wide variety of properties, but you're right, because the thing that this number takes into account is really the real true operations of the property and how it's performing with regard to operating expenses, vacancy rates, that sort of thing. Okay, make sense? Okay, good
So
question.
the top number, like, that would be what people would purchase the property at? And then
Or
can
what
see-
they, what it, and I understand where you're coming from with that question. It could be, this is what the property did sell for. It could be, this is what we're valuing it at, saying that it should sell for. It also, could be what we would expect it to sell for with the current market conditions. But the point being is, it depends on how you're using it. Because in some cases what we're doing is we're collecting that information, we're collecting that sales information for other properties to then use to value one that we currently own or one that we're currently looking at to purchase. Does that make sense?
Yeah.
If you were looking to buy that property, then you could go by what they're asking for, I imagine,
Right.
as
As a baseline.
a baseline.
Yeah,
and then-
because most of the time what you're trying to do, I mean, obvious, I'm not telling anyone that they don't know. You're trying to look, as a general rule, for or at least I do, looking for undervalued properties, okay? You're always gonna be looking for where are those market niches that you can find the property that is somehow undervalued, because as a developer, that's usually where you're going to, generate your biggest chance for success, is that maybe you bought the land super cheap, and then you're able to do your development, and then by virtue of having bought that land super cheap, you're able to then develop at a price point that hopefully is going to be very competitive with everybody else in the market. But if you had bought that land at normal market rate value, then you are going to maybe try to be shaving off cost of your actual construction to try to be competitive with everybody else, which is not usually a good thing. Or you buy it at market price, you build it at market price, you price it at market price, but then you probably walk away with an itty bitty tiny rate of return, on the project. Okay? Does that
So
make
this
sense?
this is a way to kind of help avoid
Well, yeah,
some of
you're
that.
trying to find, the way I always approach real estate investing is you're trying to find the undervalued, below market value, below replacement cost kind of properties. And most everyone is looking for that same sort of thing, but it's in many of those, they're a factor of people getting divorced, people dying, legal related problems and issues, tax lien foreclosures. There's a whole litany of things, or people perceiving there to be more work to be done on the property than what there really is, or people perceiving there to be more environmental problems than what there really are. There's all kinds of that stuff that gets sort of rolled up into this, of trying to look for those sort of undervalued, sort of properties. But this is just a way to objectively kind of look at numerically whether they're going to be undervalued or overvalued. Okay? Make sense? Okay? Any thoughts, comments, observations? Okay. Moving on. through a couple of little examples that would be helpful. All right. Okay, first of all, let's just sort of, because this quiz is going to be really a lot of things dealing with the income statement, so we're kind of working through a couple of examples, and so let's just kind of work through one here. All right, so first of all, what kind of property do we want to deal with? Do we want to deal, give me a property type.
Industrial.
Okay, I heard retail. Okay, all right, so like a little strip center kind of retail?
Yeah.
Okay, so we got a little strip center, all right. We've got, obviously several little spaces, okay. So how large are we gonna have each of these spaces in the little strip?
1,500.
That's really small.
5,000.
Let's go, yeah, 5,000 square feet for each one of these little spaces. That's a decent size. They don't have to all be the same size, but what the heck. Okay, so we've got 5,000 square feet in each of these little spaces. All right. What sort of rental rate do we want to have on these? Okay. We want to have $20 per square, whoops, right, per square foot. And that's going to be per year. Okay. And do we want this to be gross, triple net?
Triple net.
Okay, triple net. Okay, and any vacancies? 3%. Well, you're optimistic. Okay, 3% vacancy.
That's 3% annually?
That's what she said. Okay. And what about other income? Any other weird income we might get off of this?
3,000.
But I mean, what might it
You
be?
got a vending machine.
Oh, vending machines.
Okay, so we're saying vending machines, valet, upscale, okay? All right, anything else?
Parking. Regular parking.
Okay, regular parking, okay, so high demand area, all right. And so what is that other income number gonna be?
Probably like 50,000.
Oh, that's a lot.
That would be potentially.
Well, valet plus parking.
We'll go with 50,000, what the heck? All right, it's high-end parking at a low-end retail store.
Hey, it's in
Perfect
downtown.
combo,
It's in
perfect combo. Love it, okay. All right, so let's just see what we've got here. Potential gross income. All right, so in this case, we've got 20,000 square feet. All right, 20,000 square feet. Now, in this case, our rental income is already quoted in a yearly rate, okay? Because in most cases, whenever we're dealing with anything non-residential, we typically quote it on an annual basis, okay? So $20 per square foot per year, all right? Just so I don't screw it up. 20,000 times 20, so 400,000, yes? Okay, so that's going to be our potential gross income. All right, now our vacancies and collection losses, what we've said is 3% of that. So that's going to be $12,000. Okay, and our other income for our overpriced parking is going to be 50,000. Okay. All right, and then that's going to leave us with our effective gross income. $438,000 for our effective gross income. Okay, everybody good? All right. Now then, from that, we're going to have operating expenses. All right, in this case, if it's absolute triple net, are we going to have any operating expenses as the owner of the property?
No.
No. Now, here's one little thing that I'm going to put a zero there, but one thing to sort of point out. In many cases, and once again, every property is and every lease is different, okay? So just put that caveat out there. In some cases, the way that it works, and once again, those of you taking Argus right now, how many of you are taking Argus right now? Okay, the majority of you. one of the things that you're going to run into in Argus is that you may have a situation of where you as the owner of the property will have to collect all of the revenues for those operating expenses. In other words, you're getting reimbursed for the operating expenses. In other words, you're still, as the owner of the property, potentially being billed for the property taxes. You're still being billed as the owner for maybe the utilities. You're still being billed as the owner for a whole number of other things, but what happens is pretty much whenever you get those bills, then you get to pass them on to the tenants to then being reimbursed by the tenants. Does that make sense? So that you may end up cutting a check to the folks at the county tax office for your property taxes, but you're getting reimbursed for those property taxes by your tenants. Does that make sense? Okay, and that's where it can get a little fuzzy, because you will have in Argus like reimbursable expenses. Okay, and that's what they're basically sort of referring to. Yep, big question?
I'll say it.
Okay. All right. So in this case, that leaves us with our net operating income, in this case, $438,000. Okay. Now, here's one other little thing to sort of throw out. And this is a little nuanced, but I'm just going to go ahead and point it out just from the standpoint of I think it's important to sort of note. In many instances, whenever properties are being bought and sold, especially whenever people are looking at the actual real estate income, sometimes this number, and it's kind of interesting that you made it a big number. I know you didn't really mean it to be that way, but maybe you did. But the point is, sometimes whenever an outside investor would look at this property, they would say, wow, why is that number so big? And are they willing to actually give you the full value attributed to that income? And what I mean by that is this. You have some investors that are simply saying, okay, we're buying this property based upon this number. You know, in essence, we're basing it on what the real rental income is off of the underlying real estate, not this weird ancillary income that could be from a whole variety of other sources, because it's non-core revenue, so to speak. Does that make sense? And so sometimes whenever you have folks looking at investment, that number maybe gets carved out or shaved out from the NOI strictly because it's not core revenue. But in our case, we're sort of leaving it in, okay? Now, this actually brings up another point, which we're going to get to here in a second. So we go back to IRV. All right, so we've got our income number here, $438,000 of annual income. All right, and let's say that we've got a cap rate on this, I don't know, let's go pick 7%, let's say. All right, so in this case, $438,000 divided by 7% would give us $6,257,143, okay, as the value of this property. Okay, pretty straightforward, yes? Okay, now, before we go to kind of this next topic, I want to illustrate something real quick with this little simple model. So let's just say that our cap rate is 7%. Something that you need to embed in your brain is how important incremental dollars are to the value of a project, okay? So what I mean by that is if we can generate an extra $10, let's just go with, well, $10 is fine. If we can generate an extra $10 a year of income on this project, what does that translate into in terms of incremental value?
$1,400, $1,428.
So 10 divided by 0.07, $142.
Oh, I'm just
Okay? You're the one tutoring. Okay. All right.
That's bad for you guys. I'm gonna pass.
All right. $10 divided by 0.07 equals $142.86 of incremental value, okay? So that's really important because all and obviously if we, were to shave off a zero here and just put it as $1, what would that be? So basically every extra $1 would basically equate to what? $14. Well, that's a pretty big, impact. So my point is this, and this is the part that I'm trying to, whenever I say this, how important this is. If you can raise your rents just a little bit and generate just a little bit more of income and shave off your expenses just a little bit, that can have a potentially huge impact on the underlying value of this asset. Does that make sense, everybody? Yes or no? So many years ago, one of the firms I think that did an absolutely amazing job of like surveying their tenants and so forth was company. I think they're based in Atlanta, but then ultimately Post Properties. They were a multifamily company. I'm assuming they're still around. I haven't really looked into them lately. But anyway, the point being is what they would do would be surveys of all of their existing tenants and say, on these were fairly extensive surveys, they would say, how much more per month would you be willing to pay for X? So for example, one of the things they might say, how much would you be willing to pay for per month for crown molding in your apartment? How much more would you be willing to pay per month for recessed lighting? How much more per month would you be willing to pay for a certain upgrade in the carpet, or a certain upgrade in the tile, or a certain upgrade in appliances, or a certain upgrade in whatever, you sort of open your mind up to the possibilities. How much more would you as a tenant be willing to pay? Well, I mean, a simple one would be, how much more are you willing to pay for a covered parking space? Okay? And what they did was then did kind of the cost-benefit analysis and said, all right, if we can charge an extra $10 a year for whatever that item is, as long as our cost of including that item is something less than this, we're going to do it. Because it makes sense. It's going to be an overly positive contribution to the value of the project. Does that make sense, Jason?
Well, so like the 7% though is not like a constant number.
Well, it's not a constant number, but it's a reflection of the value of that additional income that you can generate off of the property.
But like, so how do you go, like, if I don't know, because you said the R is like what somebody wants as a return, correct?
It is, but it's also driven by the different players that are within that market. And so, while it's not going to be, a fixed number forever, it's going to, change, potentially go up, potentially go down, depending on the market conditions. But having just said that, hopefully, even with it going up and down a little bit here, you're still going to be able to derive value from charging a little bit more for whatever the rental is on the property and have that reflected in the underlying asset value. That's what the real lesson is. Because if you can say, just like, for example, I use the covered parking space thing, as an example, as a very real example, because in Texas, we got hailstorms all the time in certain months of the year, and so they were saying, okay, every month, people are willing to pay at least $25 a month for a covered parking space, okay? Well, $25 a month times 12, that's $300 a year of income that you could generate off of each parking space, covered parking space, all right? Well, if you've got a cap rate of, let's say, 6%.
So who determines that cap rate? Like, I know you said that you could find it, but like, so how do you find like a cap rate?
It's going to be based upon what properties have sold for in the market relative to their net operating incomes. Historical information.
And that's all like you can just get when it's historical.
Yep. Okay? So in this case, what we're saying is that parking space, or each parking space, would have potentially a value contribution of $5 grand. okay? But what they found was they could, create that carport for like $2,000, okay? So that difference between the $5,000 that would contribute to the value of the overall property and the $2,000 that it would cost them, that increment of $3,000 per space, think about magnifying that whenever you own, 50,000 residential units that you can apply that model to, and how much you can influence the value of the property. Does that make sense, everybody? Yes or no? Okay. All right. We're getting close to the mess. Oh, shit. All right. So we'll pick up where we left off here, and obviously the next couple of quizzes, we'll have another quiz, but it won't be at the beginning because we still have some stuff to cover. Okay. Oh yeah, the law class is meeting downstairs in 2079. You may or may not want to try to convince your
Move up here.
297. Whatever it is, it's downstairs. But what I was going to say is you may or may not want to convince your instructor to move the classroom from there, because I think some of you may have had that classroom before. It's the one with the little bitty weird desk, those horribly hard chairs.
I know, I was gonna like that.
It sucks. It sucks. There's good spots, but they're all the way up front.